Recently, my friend Sue Burnett came and visited the virtual meeting of the team at Payroll Partners to help educate us more on types of retirement plans. Here is Sue's presentation.
But my background is in retirement plans, plans that actually can be layered on top of a 401k, on top of a profit sharing, instead of a SEP. So if you've heard, instead of a simple, so if you've heard of these other plans, what I do is build things on top of that. So it's really important for 1099 contractors or 1099 S corps when you hear, boy, my advisor told me I can't put money in my IRA, or boy, I wish I could put more money into my 401k. I'm making $500,000, 20 grand isn't going to cut it. This is where you can say, you know what, there are options, because nobody thinks that there are. So I'm going to get through this as quickly and painfully as possible for you guys, because I do understand that I can go for days, but you guys don't want me to go for days. So first of all, retirement options are totally overwhelming. I mean, they are. You got SEPs and IRAs and Roths and what's a pension, and I thought they were dead, and after tax and 401ks, and where do you invest? And I heard something about a simple. Is it really simple? And it's just totally overwhelming for people that haven't lived it for the last 25 years like I have. So what's the end result? There's too many numbers, too much work. Even CPAs feel like this. It's too much effort and too overwhelming. So you either feel like you're whacking your head against a wall, you feel like your head is exploding, or you just go get a drink and forget about the whole thing. So what I'm trying to do for you today is explain to you at a very, very, very high level what the options are for both individuals and business owners. I tend to focus on the business owners, but we're going to go through the individuals as well, so you can really tell the difference. And how are we going to do this? The same way you eat an elephant, one bite at a time. So we're going to take little pieces and by the end build up. So you aren't going to be experts, and I don't want you to, but I'll give you some things to listen for, and you might be able to really help your clients if they're looking for additional retirement savings and additional deductions. So with options, we have individual options. You have an IRA and you have a Roth IRA and you have just after-tax savings. But if you're a business owner, and this includes 1099 people, I have 1 billion people say to me every year, and I exaggerate, but I get the point across. I'm a 1099 person, this doesn't apply to me, right? No, if you're 1099, you're a one-person business. And literally the options for business owners are huge compared to the individual options. So we're going to just briefly, and I mean brief, one quick slide, talk about the individual stuff. Then we're going to focus more on the business, which is where you see the 401ks, which is what you guys deal with, and then some other options for those business owners. So if you're an individual, if you don't have a plan at work, if you just want to save, you can put money into an IRA. You do need to actually have an income. If you're unemployed, you can't contribute to an IRA. So you need taxable income, but you can't have too much, because if you make too much, you can't put money in. Same with a Roth. You need taxable income, but not too much. Can you deduct it? Yes. That's the best part about a traditional IRA. You put money in and it's a deduction for you. But the limit is $6,000 a year. And if you make too much money, you can't even put that in. So it's a really low limit, and it's really just meant for individuals that don't have access to any other retirement plans. An option to save money pre-tax, which means it's deductible off your personal taxes, or to save things into a Roth. Now, a Roth means that you pay taxes on your contributions, so it goes in on an after-tax basis. Then it's never taxed again. So any investment earnings that you have that go along the way, you're never taxed on that again. So that's what a Roth is. And then a savings account, you put money in after tax, and then when the money comes out, when you need the money, you pay capital gains on that. So this is just a quick and easy, who can put money in, can you deduct it, are there limits, and what are you taxed on later? But these are really, if you don't own your own business or you don't work for a business that sponsors a plan, this is it for you. So that's why I have the little guy in the prior slide. This is really pretty much peanuts. The traditional IRA and the Roth is $6,000. Your savings account, great, you can save, and your market is going to go up and down, and then you have to pay capital gains at the end. So that's not even really a retirement account, that's just a savings account. So these are the individual options. And now we're going to talk about business options, which is where some payroll things come in. So when we're talking about qualified plans for businesses, there are a billion options. And you might have heard of some of these, you might not have. So to start off with, there's 3 that are really flexible, and they're called a simple or a SEP or a profit sharing. All of these are totally flexible. You can put some money in one year, 0 in the next, a little bit in the next. You can vary things every year, but the amount that you can put into these is really limited. It's fairly low. These are all called defined contribution plans. Your contributions every year are limited. Then we have pension plans, and no, pension plans are not dead. So before you say, oh, I thought pension plans were dead, if I had a nickel for every time somebody said that to me, I probably wouldn't be talking to you right now. I'd be on a beach somewhere. They're not dead. Here's 3 different types of plans. They're all the same thing. They're all pension plans. So what is a pension plan? It's big dollars, but they're less flexible. So the best example of a pension plan that I can think of is Social Security. You put money in every year, and when you retire, the benefit is guaranteed. That is the essence of a pension plan. Now, Matt said I have 10 minutes. Again, I can go on for days. We're not going to talk about all these. We're going to talk about the ones that might have 401k things, because that's where it applies to payroll. Now, if you're really interested, we can absolutely go into lots of further details, but we're only going to focus on these 3 right now. So first of all, we're going to talk about 401ks and Roth 401ks. Now, a 401k and a Roth 401k, any kind of 401k, if you hear 401k, that means it's a business-sponsored plan. The business has to decide to put this plan in. And then the contributions come from the employees off of their pay. It's a payroll deferral. So it doesn't cost the company anything other than to sponsor the plan. And the employee decides if they want to take the money as pay, or they want to defer it to a 401k, or they want to put it into the Roth. Now, what are the options for these employees? Well, you can have a 401k, which is similar to an IRA. It's deductible off of your income, but you still pay Social Security, Medicare, FUTA, all those crazy little taxes that you guys are way more familiar with than I am. But it's deductible from your income tax. And a 401k, you can defer up to $20,500 if you're under 50. There's a little bit more if you're over 50. So that's a lot more than the $6,000 that you can get from an IRA. So a 401k will absolutely let you defer more and will let you deduct more. If you don't earn $20,500, you cannot defer $20,500. So obviously, if you're only making $10,000, you can only contribute $10,000. But that's what a 401k is. And that's an employee saying, I'm making $50,000. I'm electing to defer 20,000 of it, which means I'm going to get 30,000 in pay. Again, it doesn't cost the company anything. Now, a Roth 401k is like a Roth IRA. It's after-tax dollars. So if I'm making $50,000, I get taxed on that, income tax and all these other taxes. Maybe I'm making 40 after that. I can elect to contribute up to $58,000 or 100% of my after-tax pay. So in my example, it'd be 40, and it's never taxed again. So I can defer the whole ball of wax. And if 20 years down the road, that has grown to $200,000, I'm not taxed on any of that investment earnings. So Roths are great if you don't mind paying taxes now, if you're in a pretty low tax bracket now, because down the road, you're never going to get taxed again. But you can see the limits for a 401k and a Roth 401k are a lot higher than the IRA and the Roth IRA. So business owners, especially those 1099 guys that say, oh, my advisor told me I'm maxed out in my IRA, I can't put anything in it. You can say, you know what, as a 1099 business owner, you actually could put in a lot more if you chose to sponsor your own plan. And that's when you bring me in. Like, that's all you need to be able to say, but that's kind of the trigger. And I feel bad for any 1099 people that advisors say that. So that's what a 401k versus a Roth 401k is. What are the pros? You can put in anything you want any year. You can put the max in 1 year, 0 the next, 5,000 the next. They're really easy to set up, and investments are flexible. In a 401k or a Roth 401k, you can have real estate, you could have gold if you want, you could put insurance in there, where in an IRA, you can't do any of that. It's just market investments. So what are the cons? Well, there's lower limits on contribution amounts compared to the pension plans that we're going to get to in a minute. There's no guarantees at retirement. You could put in $58,000 a year every year, but nothing is promised down the road. It depends on how you invest. So there's no guarantees with that, which make people a little nervous. And at some point, when your balance in your 401k plan gets to be over $250,000, you're going to need to have somebody do some administration and file some things with the government called a Form 5500. And it's crazy easy, but you still need somebody to do that. Now, some CPAs do it, there's administrators out there, but it's a little bit more paperwork because it is a business sponsored plan. Once it gets to that threshold, the government wants to know what's going on. So any questions about 401ks and Roth 401ks compared to IRAs, Roth IRAs? Good so far? Okay, excellent.
Sue, I have a question.
Yes, sir.
With Roth 401ks, that's only the employee's contribution is tax-free. So if the employer is contributing a match or whatever into the plan, that's always going to be pre-tax still, correct?
Mm-hmm. Yep.
Okay.
And actually, that's coming into our next couple slides. So yeah, 401k, when you hear 401k, whether it's Roth 401k or 401k, that's employee money. That's all your employee money. And then the employer portion, the business portion, will be called something else. But 401k is always employee dollars. Good question. Okay, so now that we know what 401k versus Roth is, we're going to talk about those three plans we were just talking about. The first is a simple, and it is pretty simple. It's an IRA, and it's got a 401k piece. So employees have a 401k option, and in a simple plan, you can only put in $14,000 a year. So the simple limits are lower than the normal 401k limits, but employees can defer up to $14,000. The business can do one of two things. They can either match what the employee puts in or just give everybody a flat 2%. And that's totally up to them. The business contributions don't come through payroll. They come through a business account. But the business contribution pays no taxes. There's no Social Security. There's no Medicare. There's no nothing. It's what we call a top line deduction. So if they put $10,000 in, their business income literally goes down the whole $10,000. There's no tax ramifications whatsoever. So there's two pieces to the simple. There's the employees, and then there's the owner. So the pros of this, again, it's really easy to set up. There's no government filings for this. So you'll never have administration with this because everybody gets the same thing. If the business matches the owner up to 3%, then the business has to match all the employees. And all the employees have the same $14,000 limit. So because everybody's treated the same, you never have to file any paperwork. Cons is, again, it's an IRA, so there's limited investments. It needs to be just market investments. Can't be life insurance, can't be real estate, can't do anything like that. Contribution amounts are fairly low. And when I say fairly low, I'm going to show you some really big ones, and then you'll know what I'm talking about. And again, it's an IRA, so there's nothing guaranteed. If you lose half of your IRA value the day before you retire, you're out of luck. So that's what a simple is. It's got a 401k piece, but it's also got this business match. So now we're going to talk about a 401k profit sharing plan. Now, again, it's a 401k, so now we're back to those, 19,500 limits, but the business can vary what it gives to everybody as a percent of pay. And again, those business contributions are a top line deduction. So you could feasibly give the owner 20% of pay and give the employees 3% of pay if it passes all of our little tests that we have to do. So again, the employees have that 401k and the Roth option from the first slide. They can put in up to $58,000 on the Roth, on the after tax. If they make that much, they can put in 19.5 or 25 into 401k. And the business can also put in certain amounts, but the owner can try to skew benefits to themselves. Now, if you're putting different things in for different people, you're going to need administration. So the pros of this, again, it's flexible. 401ks are flexible. Profit sharing is flexible. The business can decide to put in the maximum amount 1 year. The business can decide to put in the minimum amount, which might be 3% of pay for everybody, in a different year. But here we can skew benefits to owners. And this is a plan that many owners don't know about. If anybody's got employees and they have a simple and they think, oh, I have to give 2% to everybody, in here, if that owner's older, we can give the owner more. It's allowed to give the owner more. But how do you do that? You need administration. You need somebody like me or some third-party administrator to say, yep, we ran the numbers and it is legit that you're giving that owner $50,000 and you're giving those two employees $2,000. I'm not going to get into the numbers, but it works that way sometimes, which is really cool. So it might be worth paying $1,000 in administration fees if the owner can get $45,000 more than their employees. Just something to think about. Again, these lower contributions are out there. And again, there's no guarantees. It's 401k, it's a savings account. It depends on how you invest, is what that dollar amount's going to be at the end of the day. So this is a little different than the simple. Both of them are really flexible, but here we can really push more benefits to the business owner. And the 401k limits are higher. But it's just two different types of plans. For you guys, you would see the 401k deferrals, and the Roth 401k deferrals, because I believe that's another code that they have to report on their earnings. So those are the two really flexible ones. So let's just say I have a 1099 guy who's paying himself $100,000 in W-2. In his simple plan, he puts in his $14,000, he gets his match, he can have just under $20,000 a year. If he does a 401k, he can put in up to $26,000, either to a 401k or to the Roth. If it's a profit sharing only plan, that's limited to 25% of pay, so he can put in $25,000. That's a business contribution. Or if you do a 401k profit sharing, think of it as different drawers in a dresser. You can have a company contribution, and then you can have the employee deferral that raises it up to almost $64,000. So any business owner that just has a simple and is saying, boy, I wish I could put in more, this is a real easy way to do it, because you can put in $64,000 in 1 year and zero the next. It's really flexible, and that's fine. And you can do pre or post-tax. So there's a lot of different ways to slice and dice all of these plans. But now we're going to get into my favorite, which is the pension plans. And we're going to focus on a cash balance plan. All that means is it looks like a savings account. But here's my big dollars. It says, I'm going to define a benefit way out at retirement, and we're going to put money in every year so that that benefit is paid. So the biggest benefit that you can fund to right now under IRS rules is $3 million. How is it paid? Totally by company contributions. In a cash balance plan, there's no 401k. It's just company money. So if there's a business that is making a ton of money and they're looking for business deductions, these plans are amazing. So again, it's a full deduction, no FICA, no nothing. Top line deduction. You get to your $3 billion or whatever your bogey is at the end of the day by company contributions and interest along the way. So why would you do this? Because the contribution levels are huge. Plus, it's a guaranteed benefit. If the plan says you're going to get $3 million, you're going to get $3 million. And you can have a big boost to your retirement if you start these contributions late. And we're going to show that in the next slide. So what are the cons? Well, you have to put something in every year. You can't set up one of these plans and say, yes, I want to put in $200,000 this year, but I don't want to put in anything next year. The IRS says, if we're going to let you put in $200,000, you have to commit to do this for at least 3 or 4 years. You do need administration, and that includes an actuary, somebody to sign off on the numbers, somebody to tell people you have to put in this dollar amount. That's what actuaries do. And there's investment risk. If you have a bogey of $3 million and you're the year before you retire and you're 2.9, and you say, great, I'm going to make one last contribution of 100,000, and the market tanks, guess what? The plan still says you deserve $3 million. So if you lose a lot of money, you need to make that up. So there is some investment risk here. A cash balance plan, let's just, if you can understand this slide, then you can understand defined benefit plans. This was the best slide in one of my trainings that I had ever seen. Let's say that Matt's going to get $3 million when he turns age 65. And let's say that I'm going to get $3 million when I turn age 65. Well, if I was 55, which I'm not, but if I was 55, I could put in $300,000 a year for 10 years, and I'd have $3 million. Well, what if I was 45? You could put in $150,000 a year for 20 years, and you'd get to $3 million. If you understand this slide, you understand how defined benefit plans work. The closer you are to retirement, the more the IRS will let you put in. So these plans are great for people that are making a ton of money, emergency room doctors, high income realtors. By the time they hit their stride, they're in their 40s or their 50s. The older you are, the more the IRS will let you put in, because they realize you don't have the time to have the investment earnings pick it all up. So if there's one thing that I want you to remember from this presentation, and hopefully you'll remember the whole thing, is that pension plans really favor people that start late in their life, because the IRS will let them put in more if they're older. But you can see $300,000, $150,000. I mean, these are 6 figures. Nowhere in a simple are you going to get 6 figures, and nowhere in a 401k profit sharing plan are you going to get 6 figures. So these plans are great, and these are top line deductions from their business income taxes. These are all business plans. So now, all right, I'm done with those 3. We're just going to take an example and show you how this works. So let's say we have an emergency room doctor. He's 1099 from Christ Hospital. He's an S Corp. He's doing payroll with you guys, $150,000 a year, but his total income is $500,000. So he's W-2ing himself $150,000, but he's got $350,000 that he's taking as profit every year. If he were to do a simple, he can put in this teeny little piece of money. You know, he can put in total like $16,000. Now, anybody that's making that amount of money, $16,000 per year in retirement savings is not going to go very far. Option 2, what if we did a 401k profit sharing plan? And I threw a SEP in here too. We didn't talk about SEPs. Those are total company contributions. They have the same limits as profit sharing plans. So they're essentially the same thing. But if you had a 401k profit sharing plan and you were making this amount of money, you could put in $26,000 to a 401k as an employee deferral. So the $26,000 comes out of that $150,000 W-2, and the business could put in $37,500 because there's a cap on how much you can put in per person to these plans. A SEP just says $58,000 or 25% of pay. So you can see option 2 is a little better than option 1. We're still less than $100,000 though. But these are the 2 types of plans that everybody knows about, or even the 3 types of plans. So what happens if this guy says, I don't need $350,000 in profit. I'm paying a god-awful amount of taxes. What if we said, How about we give you a defined benefit plan plus a 401k plan? So you can have your employee deferrals, plus you can have both of these plans together. It's A plus B. So maybe this business owner, for whatever age they are, the minimum amount they have to put in every year is $160,000. But if they wanted to max it out, they could put in $190,000 from their profit. So this gets paid from the $350,000. They could put in $26,000 in 401k, which is from that $150,000 W-2. And then they could also make these after-tax Roth contributions, which would come from their after-tax W-2, of another over $38,000. All of this is retirement savings. All of this would have a 10% penalty if you pulled it out before 59 and a half. But all of these, other than that Roth, are deductible. And so for big, heavy hitter business owners, if they don't know that these pension plans are out there and they're stuck way back here, these are really good ways to make friends with high income 1099 people. I don't expect you to remember the names of these things. I just want you to know that these are out there for people that are being limited in the amount that they can contribute and limited in the amount of deductions that they can take. So just you guys being aware that they're out there is going to be helpful.
Awesome. Thank you so much, Sue.
Yeah, so we're just going to wrap it up and say nobody's a fortune teller. The individual options are those three. Business owner, there's tons of options, but rules and complexity. Just listen for those owners that want more. They're limited. They don't have a 401k, but they want one. They have a SEP or a 401k, but they want more. They have something, but they want a Roth on top. Or that famous, my advisor says I'm not eligible for anything. Those are the ones that you just have to say, we can help you out. And again, I'm focused on business owners here. So those 1099 people are great. And that's it. So hopefully I stayed to my 10 minutes. I probably went over, but
you're okay.
Okay.
Thank you, Sue. Anybody have any questions for Sue?